Welcome to Dr. Fred Markets. This is not financial advice. Most people will never understand how crypto, AI, and global finance are reshaping the world. The rules are changing, and the ones who adapt early come out ahead. You're here. You're paying attention. That already makes a difference. Let's go.
You're losing to NBA team owners, and you don't even watch the games. Signal 1. NBA franchise prices went vertical while you were doom-scrolling Tesla. In 2014, Steve Ballmer paid $2 billion for the Clippers, and people called him insane. This year, Forbes values the average NBA franchise at the $3.85 billion. That's a 10-year, roughly 10% annual compound win from a basketball team. S&P over the same stretch? Strong, but franchise multiples left it in the dust with way less day-to-day volatility. Signal 2. Revenue isn't the driver, scarcity is. The NBA has just 30 teams. That's it. No SPACs, no IPO flood, no new supply. Each media deal ratchets the floor higher. The latest US rights package on the table? North of $70 billion over 11 years. That's a pipeline of guaranteed dollars flowing into a fixed number of assets that never get diluted. Compare that to your favorite growth stock, constantly issuing shares like Halloween candy. Signal 3. The cultural fire hose just keeps opening. Today's headliner, Taylor Swift hitting the Cavs-Knicks game in Cleveland with Travis Kelce. That's not celebrity gossip. That is free, compounding marketing for the NBA as a global live event religion. Every time a megastar sits courtside, the league sells its product to millions who never check a box score. Brand reach extends, international fans multiply, future media deals price that attention in. Here's your cliffhanger. You don't need $4 billion and a vanity complex to ride this. There's a sneaky way regular people tap the same engine that made franchise owners disgustingly rich, and it's hiding in plain sight next to your boring index fund. Here's the connection. Sports franchises are not fun toys. They're monopoly-adjacent media infrastructure. They own 3 things you keep underpricing: attention, habit, and schedule. Attention. Live sports are the last thing people watch together, in real time with ads they don't skip. Habit. Fans show up 82 times a season, every season, through recessions, elections, and pandemics. Schedule. Leagues control a calendar that advertisers, broadcasters, and sportsbooks must pay rent to enter. You're staring at headlines about peace talks, elections, rates, but live sports just keeps cashing checks independent of that noise. While you argue about Nvidia at 30x earnings, a closed cartel of 30 owners enjoys assets that reprice higher with each TV deal, streaming pivot, and sports betting regulation change. Their profit isn't EPS growth, it's multiple expansion on cultural dominance. The mechanism is simple. Step 1. Leagues grow total audience through global expansion, celebrity signal boosts, and social media virality. Step 2.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Broadcasters and streamers, desperate for content that actually moves subscribers, pay more and more for rights. Step 3. Franchise valuations adjust upward because every future dollar of media, sponsorship, and betting revenue now gets discounted at a higher base. You saw it when regional sports networks imploded. Everyone cried, the model's dead. Reality, the content didn't vanish. The negotiating power just shifted. Streamers, big tech, and sportsbooks line up to bid for the same finite games at higher blended rates over time. That's a cartel raising rent on the entire entertainment stack. So what do you do if you don't own a private jet and a championship ring? First, stop treating sports as distraction. It's a cash flow machine. Learn who monetizes the games. Publicly traded teams in Europe and a few in North America. Global sports media giants, sportsbook platforms, and live event venue operators. Look up actual tickers, dig into revenue mix, media, ticketing, sponsorships, betting integrations. Second, measure attention yield, not dividend yield. Ask, how many live eyeballs per year does this company command, and how replaceable is that content? NBA rights, NFL Sunday, Champions League, these sit at the top of the pyramid. Reruns, scripted content, generic reality TV sit at the bottom. Capital flows to the top because churn drops when fans have to watch live. Third, think like a minority owner, not a swing trader. The edge is time horizon. Billionaire owners don't flip teams on earnings. They sit for decades while media deals stair-step valuations up. Your version is allocating a small, intentional slice of your portfolio to companies and funds whose business model is own the games, own the building, own the rights. Verdict: the rich stopped gambling on sports and started owning the systems that tax every eyeball. You are still on the wrong side of that trade. So here's your one concrete takeaway. Live sports is one of the few remaining scarce attention monopolies, and markets quietly reward the people who own its infrastructure, not its jerseys. This is not financial advice, but here is the truth. 1. Sports franchises are closed-supply attention monopolies disguised as toys. 2. Their value tracks media rights and cultural gravity, not box scores. 3. Your job is to find the publicly traded plumbing around those monopolies and decide, with your own research, if you want a tiny slice of what billionaires already know. If you learned something about why team owners get rich while you're rage-betting parlays, subscribe. Tomorrow, we'll break another thing Wall Street politely ignores. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.